Hello, everybody, and welcome to the Cyclical Investors Club YouTube channel. My name is Corey Kramer. Today, we are going to be analyzing United Parcel Service stock. This one came in by request a while back. I had it up on the chalkboard. I got another request from over on Patreon today, and the stock is down about 15% today as I'm recording this. So I thought it would be a good one to cover, and also I'm going to use this and put it in my case study playlist because I think there's a lot investors can learn from UPS and kind of what's happened with the stock recently over the past couple years. And I think that's all. All right, so let's get in. As always, this is not individual investing advice. It's just how I analyze stocks. Let me move my face down a little bit. Okay, so when we look at the long-term earnings history of UPS, we can see that back in 2008, during the Great Recession, earnings were pretty cyclical, honestly, a little short of 50% drawdown for these 2 years. And then they recovered pretty well. I would look at this and generally call it like a moderately cyclical business. So you can use earnings to analyze businesses like these, but you want to take into account these down years unless you know you're in one, like you're in a recession and earnings have already been down a couple years, and then you can assume you'll probably have a run as long as they recover for several years after that. So you don't have to kind of take it into account if you know you're in a recession. But if you're doing estimates at the peak, or you never know when the peak is going to be, but when you're far away from the last recession, then you want to understand that earnings aren't going to necessarily go up in a straight line, right? So you want to take that into account. I covered this stock on Seeking Alpha with an article back in 2022. And then again, I made a video here in 2023 about the same time of year, I think, for both of them or near it. And what I did was in my article, I warned investors right around this peak, I think it was either December or January, about the downside risk for UPS. It was actually at the end of 2022. So it was actually more like right in here. And then the video I made was a similar video to this one I made a year later. I went back and watched some of that video, and I actually I was pretty impressed actually because I got everything pretty right in both of those situations. So I'm going to go back and show what you could have seen ahead of time to avoid this big decline in UPS. So let's see what we're down. And we're going to be down an additional 15. So it's going to be down over like 50% off the high right now. So what I want to do is for people to see how they could have avoided making the mistake of buying this stock and holding it through this downturn that we're in now, so that hopefully you can use those principles to avoid making the same mistake again in the future. Now, it kind of sucks that if you own this one, that you made the mistake, but all the strategies that I have came because I made some mistake, and then I went and figured out what it was that I didn't get right and try to correct it in the future. And that's really all you can do. I mean, you can learn from other people's mistakes, which is better, but once it's happened, that's kind of all you can do is learn and apply it next time around, so you try not to make the same mistake again. So let me go back to a couple screenshots that I took from the Seeking Alpha article that I wrote. We can kind of see where it was here. Yeah, so this would have been like December 2022. So what I'm trying to show people in this clip here, or this snippet, which I put in my other video too last year. It's where I stole it from, actually, because you can see me up here in my old setup. So I was pointing out that this 20% earnings growth year came because of tax cuts, corporate tax cuts, and that those tax cuts probably weren't going to happen again. Of course, I didn't think Donald Trump was going to get elected again and try to cut taxes even more. But I think even if we do get those tax cuts, they won't be as big as the ones that happened previously. So maybe there will be more corporate tax cuts. But at the time, I thought, look, this is a one-time kind of anomaly that we shouldn't count on happening again. And that's important because when you're using earnings growth to calculate future earnings, if that growth only happens one time and it's not a steady every year, it keeps getting higher and higher, then you shouldn't be forecasting that growth to happen over and over again in the future, steadily over in the future. So you want to control for that by paying attention sometimes when these weird things happen, which we've had a lot of them, or several in the past few years. So then next we had the pandemic, right? So there were two stimulative kind of things that happened with the pandemic. One, people ordered more stuff instead of going and getting it themselves. And two, we got a bunch of stimulus money in the US for people to buy more stuff, which is exactly what we did. And so you get this 47% jump in earnings, okay? And so both of those jumps were kind of one-time deals, and probably the pandemic one, we should have assumed that once that situation was over, people would have at least some of the stuff that wasn't like reusable, that need to be replaced, that they would need less of that in the future. So we should expect some kind of a bust, right? And so that's what my little graphic here is trying to show. So I'm saying all this at the end of 2022. I was actually broadly saying it at the beginning of 2022, but on this particular stock, I didn't cover it until later in the year. Okay, so next, this is the other screenshot from that same article at the same time. So what I'm trying to show with all these, with all this markup here, is that projected earnings at the time were expected to be like 12 something a share, it looks like. And I was pointing out that even if you add inflation and you just took the normal trajectory that things were on, and you kind of try to cut out the pandemic boom earnings, that really $10.40 would be kind of what the projection would be. And so I was pointing out that these earnings estimates were probably going to miss, basically. And I ended up being too optimistic. They came in between like $8.50 and $9 a share, I think. Well, we can look. They came in at $8.78 for 2023. So $1.50-ish lower than what I was even saying. And I was being pretty cautious and like bearish compared to almost everybody else. So again, this was foreseeable. Like it really was. Now you don't know what the exactly what everything's going to be, but you can definitely see what the danger is, because everybody had priced in this optimism, that, or trend or whatever, when they didn't, like, there was no reason to do that, or at least a reason to be cautious about it. So I also want to look at, I think since I decided I was going to make this a case study, I went back and asked ChatGPT what reasons people were giving during this period for buying UPS stock. And so I'm going to go through some of these and explain why they weren't good reasons. Okay? And I think most of them, there's a reason why. Every now and then there'll be like a good reason mixed within the ones that are not great reasons. So, and this is from 2021 to the first half of 2022. So it was the period leading up basically to the first article that I wrote. Number one was strong e-commerce growth. Well, we know that was stimulus boom. I mean, it did not take a genius to like figure that out, and that it couldn't go on like that forever. So that was not a good reason. Number two, pricing power and revenue growth. Well, revenue growth goes along with the pandemic boom, right? And pricing power was because people got stimulus money, and so they were willing to pay more money and not be price sensitive in a way that they would when they had to actually have like a budget. Okay. So again, totally explainable by the stimulus, or first by the pandemic and by the stimulus, and the combination of the two. All right. Strong earnings and dividend growth. Okay. The earnings growth, once again, which I'll get into this more, and I did in my last video, earnings growth was not that strong. The reason I avoided this was because earnings growth wasn't very good once you controlled for those factors that I talked about earlier. Okay, so that's just false if you control for the obvious earnings inflation or whatever, or one-time earnings boost, maybe is the way to say it. Dividend growth. Okay, so if we go, I'm going to shrink this for just a second. And okay, good, it disappeared. Sometimes when I click off that little thing stays up on the new Fast Graph. I do have a 25% off affiliate link for Fast Graphs down in the description. It's really useful to visually see this kind of stuff. Okay, at least a good portion of it. So I was going to show, the dividends. Yes. So if you'll notice, we have a huge dividend jump. This is going from $4 to $6. So a 50% dividend increase, okay? Now, I'm going to try to be somewhat diplomatic. I'm not, all right? This was the dumbest dividend increase, one of the dumbest I've ever seen, all right? From a S&P 500 company, not some place that's just trying to get dividend because anybody should have known. A CEO of this company should have understood that this pandemic boom was not going to last. So without imparting any kind of intent on what they were thinking, this 50% dividend increase is kind of crazy, right? Because earnings are going to fall. You don't know how much maybe they're going to come down. But you should understand that the risk of earnings going down is high. And raising your dividend by 50% in 1 year is just dumb. All right? It just is. So when this happened, I went back because I was writing about an article about this time, and investors were just going kind of bananas. Dividend investors were going bananas over this. They loved it. It was the greatest thing ever. The new CEO is fabulous. On and on and on. I read through dozens of comments about that. Okay. And this is why you can't focus on dividends. You can't. This is such a good example. They're eventually probably not, earnings are probably going to fall below the dividend payout soon. You can see this white part here. So the dividend payout is 84.5%. I think they beat earnings by a little bit. But still, they're basically maxed out. So if they lose any more earnings, if earnings fall any more, they're going to be paying more out in dividends than they actually earn as a business. That wouldn't have happened if they would have kept a more conservative and realistic dividend rate. And keep in mind, we are not in a widespread recession. They had an industry bust that acted like a mild kind of recession, or acted like a recession. We have kind of a goods recession. It sort of depends on how you want to talk about it. I talked about it in the last video. I called it like a goods recession or a mild, but the whole economy is growing, right? It's just services are kind of propping everything up. So you can kind of debate how you want to categorize it. So far, earnings have fallen almost the same that they fell during the Great Recession, which was a real recession. We could still have that, right? So if we have that in the next couple years, these earnings are going to be even worse. And they're going to be feeling like they need to pay this dividend now. And all the people that bought the stock when the dividend increase was announced, it was just somewhere around here, who jumped in, are down 30%. So yeah, they made, what was the yield? They've had 2 years with a 3.5% dividend. So they made 7% in dividends, and they lost 30% in the value of the business that they bought. Right? So it's more than 30% because it's down 15% more today. So it's even worse than that. But, the dividend, right? You got to look at the business. You can't just look at the dividend. All right, back to the reasons to own. Supply chain disruptions benefiting logistics. Okay, well, that's the pandemic, which isn't going to last forever. Should have known that. Again, growth in healthcare logistics. I listened to the CEO today on Bloomberg. She answered some tough questions, so good for her on that. And it sounded like healthcare logistics was something that was going reasonably well. with mid-single digit growth, if I remember correctly. I mean, but it's growing at least, right? So maybe that's something that can keep up. I'm not sure. Competitive edge versus FedEx and other rivals. Yeah, I don't know about that, right? Although FedEx is horrible. They lost one of my packages this week. There was literally no way to they did literally nothing. I had to contact the company and they had to send me something new. So FedEx, yeah, they're not any better, but it is what it is. All right, resilience despite market volatility. Yeah, they're resilient now, I guess, huh? That's just totally false, right? Because we can go back and look at the Great Recession, look at the peak. Well, let's pick a 206 is when the housing market kind of peaked. So if you do it from there, stock fell over 50%. Earnings fell almost that much. So that's the same as the average in the economy. It's not any more resilient than maybe like a Main Street business, but not any more resilient than any other S&P 500 business. So those are all the bad reasons that people had, which it's worth looking at these type of things to figure out how we got down like to where we are here. All right. Now, let's see if I can pull up my spreadsheet here, which there's not much on it, but I want to show you how it looks. If you look at any of my other spreadsheets, usually I have a buy price. I have like a recession buy price. So the problem, when I made my video last year, I was pointing out that the earnings growth rate was too slow. It was actually in between 3 and 4% at the time. It wasn't quite this high. Just marginally, probably because I changed the dates as I updated it throughout the year. But we can see 3-year revenue growth is negative 6.79. This is bad. It's a little tricky to put too much emphasis on this because we're coming off the pandemic bust, basically. So I don't want, but if this came during a non-recession or non-industry recession time, then that would automatically be a sell. It lets you know that they just don't have a competitive, like they're facing competitive pressures or consumer tastes are changing or something along those lines. Now, I think a case could be made if longer term earnings growth still was really good and this was just like a temporary overshoot to the downside, I would consider, I wouldn't totally write the stock off because of this metric, which is normally what I would do. I would just avoid it and go away. The main problem here is that earnings growth has been very slow. So we've had, I think during this time frame I used for this, we probably had 3 to 4% inflation. And this is like 4.5% earnings growth. Now, what I did when I calculated this, so if you look at the fast graph, I should talk to fast graphs and have them see if they can make a couple adjustments so I can just do exactly so I don't have to make adjustments myself. But maybe that'll be a future project. So I don't know where I sat this at, but if we just look right here, so earnings growth now is 5.71%. After the earnings came down I think I was using these last year. So earnings fell 12% this year. Let's see if we do this, if it's any worse. Oh, look at that. So now the earnings have come down to normal, you can see that the earnings, and they bought back, I forget how much buybacks they had now. But once I take that into account and you take kind of where they're at now, you're getting a more honest, more accurate dividend or a more accurate earnings growth number of like 5%, which is kind of where I'm estimating too. But before, if you would have done this back when I wrote my first article, so earnings growth was 13%. And this is the problem. People don't take into account a recession, which is kind of what happened, or that those dynamics happened. And then they don't take into account this was not real, this 20%, the 47% or one time, and this 47% was one time. And so you couldn't count on that happening. And in this case, you can count on it reversing, which is exactly what's happened. What I don't understand about these executives sometimes, and it would be interesting to maybe ask them, maybe I should write Bloomberg and have them ask them, is how did you not know that earnings were going to fall and just plan for it and tell people that that's likely to happen and we're going to do what we can to mitigate this and, go from there? I mean, you seem much more intelligent when you do that than when you come out and you announce, oh, we're cutting our deal with Amazon. We're going to charge people, we're only going to do high margin business. And so it would be so much easier, I think, probably because they couldn't do it. They were busy raising the dividend. They couldn't do it back here because it would just be too I guess it would just be too negative. Like, it's not what people wanted to hear. So much people seem to get paid for just telling people what they want to hear. And then because all this to me was foreseeable. In my other video, I said, you should expect 2 years of downturn. And we were only 1 year into it, like a minimum of 2 years. And then I said, we don't know what's going to happen, which we don't. I really don't know. I don't know if they're going to trough out here earnings wise. And really, because a lot has to do with the macro economy too. We just had kind of this post-pandemic bust, but the macro economy could still fall apart, and then the wheels could really fall off. And then what happens? Oh, well, eventually they cut the dividend, or maybe they get rid of the CEO and the new CEO comes in and cuts the dividend. And they're like, kitchen sink quarter. And then even the folks that are down 15% today will be down another 30%, when that news comes across. So like all the potential bad news isn't even in the stock price yet. So if you haven't figured it out by now, I think the stock's in a void. I thought it was in a void for 2 years now. And probably that dividend cut is what you want to see before you really consider buying into the stock. Because, unless the economy just explodes or whatever, and maybe inflation could help them too. But it's just, even going pre-COVID, earnings growth wasn't that great. It was just okay. They were earning 1 or 2% more than inflation, which is fine, but it's not what I really want for a stock investment. So any investment probably in UPS is going to be a mean reversion type of a thing where, let's say it really gets down to these kind of levels here, and then you buy it and you think, okay, maybe I can get like a 50% return, right, in a couple years. That's not so bad, but it's just not my favorite type of investment to make. And what could make it appealing during this time, if it looks like things are getting fixed, or maybe it just gets really oversold, like with the dividend cut, then maybe you get like 100% potential upside. And then it gets a little interesting for a small position. And then once you get that and they get back to their normal kind of 4%, 5% growth, then you can just sell it and maybe you make 20 or 30% CAGR over 2 or 3 years or something. You call it good. I might be tempted to do that if we weren't in a recession, but if we have a real recession, there's going to be much better companies to buy that are cheaper. So it's going to be kind of hard to pick this one up in a situation like that. So chances are I won't be buying it, but I'm going to say never say never. I still watch it. So if you found this useful, hit the like and subscribe buttons. I put out videos several times a week. I take requests. Still have a bunch of these up on the board behind me. And I will see everybody later.